There's a lot of videos and content out there that talks about what should your net worth be in your 30s, your 40s, your 50s, your 60s, and it's helpful. It's good to have some perspective on how's the average person doing. But the follow-up question is, how much should my net worth be increasing each year? Well, in today's video, I'm going to walk you through how you should think about net worth in terms of your ability to make sure you're on track for your financial goals. Hey everybody, I'm James Knoll, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. In today's video, we're going to talk all about net worth and when is it important to track versus when is it not important to track, or really maybe even distracting to track. And to start, let's look at an example. So as we're looking at how much my net worth be increasing, let's look at 3 examples to see how this can change based upon different circumstances. To start, let's assume that you have $1,000 saved, and that's your entire net worth. So very simply, you have $1,000 saved, and this year you save an extra $10,000. In year 1,000 turns to 11,000. Well, what did your net worth increase by? There was no growth on your savings or your investments. Your net worth increased by 1,000%. It went up 10 times from 1,000, increasing by an additional $10,000. So that's example 1. That person increased their net worth by 1,000%. Now look at example number 2. Let's assume that that same person has been doing this for a number of years, and they've now grown their portfolio to $100,000. Let's assume that $100,000 doesn't grow at all, so the market's flat, and let's assume they put in another $10,000. So same exact input as the first example, the only difference is now they're starting from 100,000 instead of 1,000. Well, in this example, their net worth only increased 10%. Even though they took the same exact action, they saved the same exact amount, their net worth went from 100,000 to 110,000, which is an increase of 10%. Now let's look at a third example. Let's assume that same person has now increased their net worth to $1 million. Let's also assume they're still saving that $10,000 per year, but now let's assume the market drops by 10%. Well, in this example, their net worth would have decreased by 9% per year. So start at $1 million, the market drops by 10%, so $1 million turns to 900,000, then they add $10,000 to it, so they're at $910,000 by the end of the year, which means a decreased net worth of 9%. Now you start to see where the challenge is. In every single example, this person did the same exact thing. In example 1, 2, and 3. But in example 1, their net worth increased by 1,000%. In example 2, their net worth increased by 10%. In example 3, their net worth actually decreased by 9%. So as you're looking at this, you can start to see a little bit of the challenge of understanding a specific consistent growth rate of net worth, because it's going to be a mix of some things that are in your control versus other things that are fully out of your control. Now, another angle I want to take with this is, let's say that 2 people show up and they show up in my office and they say, James, we want to retire. And person number 1 says, I have $500,000. Am I in a good position to retire? Second person says, James, I have $5 million. Am I in a good position to retire? Well, we look at that and say, oh, the person with more money is probably in a better position to retire, but it fully depends. It depends upon other income sources like Social Security or pension or rental income or part-time income, and it depends on what they want retirement to look like. Person number 1 could be in a much more secure position to retire if their living expenses are much lower and maybe they have great, strong Social Security or pension or other income sources. Whereas person number 2, even though they have a much greater portfolio balance, if they want to live an unsustainable lifestyle in terms of how much they're spending, they could be in a horrible position to retire. So what you start to see is net worth is important, net worth can be telling, but net worth isn't the be-all, end-all. So in today's video, let's talk about what things should you focus on versus what things shouldn't you be focusing on, knowing that if you do these things right, the rest will take care of itself along the way. So as an investor, there's a whole bunch of things that are in your control and there's a whole bunch of things that are out of your control. Let's start with what's out of your control. Well, what don't you have control over? The big one is the stock market. So as you're looking to say, how much should I be increasing my net worth by each year? Well, in some cases, it doesn't matter how much you're saving or investing. If there's a down year in the stock market, your net worth probably isn't going to increase if a lot of your net worth is focused there. So you cannot focus or you cannot control the stock market. Another thing you can't control is emergencies or maybe job losses. Let's assume that you're saving and you're investing and you're growing towards your goals and you're increasing your net worth, and then an emergency happens. Well, when an emergency happens, what you're going to have to do is you're going to have to start living on some of your cash reserves. You're going to stop putting money away into investments. Your investments probably aren't going to grow as much as you're not being able to invest more into them. So in years like that, there's just going to be a natural setback or a natural pausing of the growth of your net worth. And then even taxes. Taxes are just something that we can't control. So all of these things, whether it's a stock market, whether it's tax legislation, whether it's emergencies or job loss, these are just things that happen along the way that you really don't have a lot of control over. What do you have control over? Well, you have control over your savings rate. When you do have income and you do have your job, what percentage of it are you putting away? You have control over your spending rate, how you budget, how you manage your cash flow. As income's coming in, are you budgeting appropriately? Are you making sure to live within your means? Are you making sure to allocate money to the right places to make sure you're on track for what you want to be able to do? While you don't have control over the stock market, you do have control over your asset allocation. So how much are you in stocks versus bonds versus cash? What kinds of stocks, what kinds of bonds are you putting your money into? So no, you can't control what the S&P is doing or what the stock market's doing, but you very much can control how are you invested in it, which matters because the ups and downs of the market, that's not what gets people tripped up. That's not what ruins people's ability to retire. What ruins their ability to retire is being invested in the wrong way in the stock market or having the wrong reaction to the stock market when it does decline or when it goes up. So your asset allocation is something you very much control. Career advancement. No, we can't control those job losses or we can't control different things that happen to us along the way, but we can very much put ourselves in a position to grow our careers, to grow our income, to do the things that give us more income, more discretionary income that we can use to save, to do things like increase our net worth, to increase our savings, to increase our investments over time. And then we can make sure that we have the right protections in place. So we have the right protections, whether that's to protect against an unexpected job loss, the protections to protect against unexpected passing, to protect against a health event, to protect against a long-term care event. How do we do the right things to protect against what could go wrong so that we can focus on what could go right with our savings, with our investments, with our planning for the future? And then finally, and this is kind of a piece of our spending rate and our cash flow management, is we have control over our debt or our leverage. Are we being prudent with how we're spending? Or are we putting too much on debt? Are we incurring too much debt, taking too much on, which is going to inhibit our ability to grow our net worth over time? So I want to make the distinction between these two, because to go back to the key question at the beginning of how much should your net worth increase over time, well, your net worth is a factor of two things: the things outside of your control and the things inside of your control. The more we spend time focusing on what's out of our control, what's the stock market going to do? What's the new tax legislation going to look like? Things that we cannot control even if we wanted to, the more discouraged we're going to be, the more we're going to give up. When we can focus on the thing that is in our control, or the things that are in our control, the more we're going to have a better outcome. Because successful planning, just like anything, is about focusing on the inputs, not on the outputs. Focus on the right input. Do those things consistently, time after time after time again. And yes, there's things that you can't control. And in some years, it's going to deviate in ways you don't want it to deviate. But over time, if you're controlling your asset allocation, if you're controlling your spending rate, if you're controlling the things that you're doing, your net worth will be growing in a way that's positive. So the takeaways from this, as you're understanding or you're wanting to understand how much should my net worth be increasing each year, number one, know your inputs. What inputs are needed for you to be on track for your goals? Many people, retirement's a goal, okay? Your input, number one, the first input, the first thing you have control over is, do you have a plan? Do you have a plan to get there? That plan is going to be comprised of different components. How much are you saving? What is your asset allocation? How are you managing your spending and your budget? All of those things are fully in your control, and those are the inputs that you should be focusing on. How many years do I need to work? How much more do I need to save? How much do I need to allocate to different types of investments? Understanding how that will change over time. That is focusing on your inputs, not focused on what did the market do this year? What's going to happen with this investment? What's going to happen with taxes? That's fully out of your control. Number two, once you focus on the right inputs, understand the range of potential outcomes. So the stock market averages 10% per year. And when I say stock market, I'm using the S&P 500. So the biggest companies here in the United States. Now, long term, its average is almost exactly 10% per year. The interesting thing, you've probably heard me say this in a lot of videos, is this never once returned exactly 10%. In fact, only in a handful of years has it even come close to 10%, meaning has it even been between 8% and 12%. Only a handful of years in its history has it even come close. So as you're looking at your net worth and what it should be increasing by, understand the range of outcomes. If you're doing the right inputs and you're saving to your portfolio and you're saying, oh my gosh, my net worth is decreasing. Well, is it decreasing because you're doing something wrong? You're not saving enough? Maybe you're taking on too much debt? Maybe you're pulling money out of your portfolio when you shouldn't be? Or is it decreasing because of something outside of your control, but something that's totally normal? Maybe it decreased because the portfolio value is down 30%. So you're saving your amount, you're putting the right amount in, but the portfolio is down. Don't be discouraged by that. Your net worth decreasing in that scenario is not a negative thing because that's well within the range of expected outcomes. The market could be up 40% in a year, it could be down 40% in a year. So if we understand the things that we can control, and if we give ourselves a range of outcomes to expect, setting the right expectations is the key to allow ourselves to continue to focus on the things that we can't control. And then finally, number 3 is be able to tell yourself a story of what happened. Meaning, as you're increasing your net worth, there's different ways you can go about it. Maybe it's by paying down debt. Again, your net worth is simply going to be what do you own minus what do you owe. So assets minus liabilities equals your net worth. So let's say you have a bonus and it's a large bonus and you say, okay, wow, I can put this in savings or investments and increase my assets, or I could use this to pay down my mortgage or pay down debt and decrease liabilities. So both of those things are going to have the same output in terms of how your net worth is growing by, but it's going to look different. Or back to the previous example, maybe you are focused on the things that you can control and you're chipping away and you're saving to your 401k and you're saving to your Roth and you're doing the right things, but the market fell or something else happened or you had an emergency and you had to live on some of your emergency fund account. So as your net worth is rising and falling each year, be able to tell yourself a story of what happened. Is it falling because of something that you can control and something that you're doing wrong? Or is it simply falling because there's an emergency and you needed to access emergency cash? Or because there's a downturn in the market? Or because of some other factor that you willingly made the decision to pursue? So at the end of the day, just keep this in mind. There's not a percent that your net worth should increase each year. It's not 10% or 15% or 20% or even 2%. There is no number. Your net worth is going to be a factor of 2 things. Things that are in your control and things that are out of your control. The more you focus on what's in your control, the better off your net worth is going to be over time. Thanks again for watching. This is James Canal with the Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think could find value from it. And also be sure to like this video and subscribe for more content like this. And if you want more resources about how you can create a secure retirement, be sure to check out our podcast called Ready for Retirement. And finally, if you're interested in seeing how our services can help you create a secure retirement, check us out at rootfinancialpartners.com.